I mean, you are expecting Tampa to win, Tom Brady, right?
I mean, absolutely, that's what I want, but it's a tough one, right? It's the ultimate new school versus the old school, right? You've got Mahomes, who is just already a legend in his own right. He's just fun to watch. He's a great kid. He's awesome. I mean, you can't not love him. And then you've got Tom Brady, the ultimate goat. So I think that it's going to be a great game. This is the first like Super Bowl I'm super pumped about in a long time, and not just because of my home team playing in their home stadium, but also just because it's going to be a great game, a really really good matchup.
I mean, my guess is it's going to be one of the highest rated Super Bowls ever. Just the whole, like, Brady versus Mahomes, like the greatest of all time versus the heir
Hmm.
apparent. And
Yeah,
both teams have, Brady's got a huge fan base nationally, and, Mahomes, a lot of Mahomes fans. So,
exactly.
should be fun.
Yeah, and a lot more people watching alone in their homes and not at big Super Bowl parties too. I think that'll help the ratings.
Right. That's true. I didn't even think about that. Oh my God.
Yeah,
So they're probably, think about it. I mean, my guess is they're charging even more, right, for commercials, because so many more TVs are going to be tuned into the game without
yeah,
big parties and big gatherings of people.
I have
yeah, yeah,
a Super Bowl
exactly.
question. So why is it the first time ever that they're playing in their home?
It's the first time a Super Bowl team is playing in their home stadium in the entire history of all of the Super Bowls. It's never been so that one of the teams playing is actually ends up being in their home stadium.
And
So
is
this
it
is
because
a
they and forgive my stupidity, but is it because
yeah.
they preset where it's going to be, and so it just so
Hmm.
happens that the Buccaneers? Wow, awesome. Okay,
Yeah, yeah. They usually have it set a few years in advance. I don't know exactly how many years, but it's typically set a few years in advance. And
so
so
it's Tampa's turn, and they just have to
yeah,
be in.
yeah,
Awesome.
yeah. Things just really worked out for Tampa this year. It feels good. It feels great. I'm trying not to get too excited, but I feel great about it.
Awesome. Well, we are live. You guys have a great episode.
All
Thanks.
right. All right. Good afternoon, everybody. Rich Swerbinsky with the Mortgage Collaborative here for the last week in Mortgage Today. And as always, co-hosting one of our lender members. I kind of handpick every week. And this week, I am super thrilled to have the Chief Operating Officer of Loan People, Erin D, is my co-host. Erin,
Hey,
thanks for joining me.
my pleasure.
So before we get into the Super Bowl, and I know you're a Tampa Bay Buccaneers fan, so I want to get some expanded thoughts there. Um, a really cool story, Lone People, and just a little backstory. I remember I first saw you speak at a Motivity conference, like, I don't know, 5 or 6 years ago. I was just super impressed by you. And we kind of connected, and you've worked for a couple TMC members now, but went over to Loan People. And, I've talked before about our kind of like strategic approach to growth where, quality over quantity. And a lot of times we're recruiting people more than we are companies, because we know great people can do great things with great companies. And that was clearly the case here when I saw you went over there, and want to thank you for joining TMC. And why don't you tell everybody a little bit about Loan People, because the story's cool.
Yeah, absolutely. So in 2018, towards the end of the year, I was approached by a local originator who is a top originator, Max Lehman. He approached me and he said, "Hey, I think I wanna do this. I think I want to start a new company, and you're kind of the person I hear is the person to talk to." And I was very happy at my prior organization. I loved them. They were a great company and treated people well. And so it really was kind of a tough discussion. Spent a good 6 months talking about it, and then I finally decided to take the plunge and left my prior job in May of 2019 and spent the rest of that year setting up the company from the back end, putting in our LOS, putting in our investors, warehouse banks, all that kind of thing. And he joined me with our production January 3rd of 2020, and we just hit the ground running. So 2020 was, what start a mortgage company. It should be a good, easy year to do it, right? So we spent the whole year, battling not only just being a startup and trying to, get our legs underneath us, but obviously the same thing that everyone else dealt with in the industry. And it was very rewarding. We're extremely lucky as an industry to have faced the tailwinds that we did last year, and it really was good for all of us. Loan People included. We did over $500 million in originations our first year, so it was really a good one.
That's awesome. For
Yeah.
those that are just jumping on, it's the last week of Mortgage Today. Rich Twerbinsky with the Mortgage Collaborative. I am joined by Erin D., the Chief Operating Officer of Loan People out of Austin, Texas. And Erin, I know you're a Tampa Bay Bucks fan. Grew up in Florida, went to UCF. Got to be super stoked about this Sunday.
That's an understatement. I am pumped beyond belief for this game. It's going to be such a great one.
Should be a great game. 3-point spread, the greatest of all time versus the heir apparent. Two really great quarterbacks. So we were talking before we kind of went live here. It's going to be so many TVs with no, big Super Bowl parties. My guess is that whatever the cost, the astronomical cost of commercials, even more astronomical this year. And there's probably going to be, we know already there's going to be some mortgage commercials. So, I mean, it's Quicken and UWM
Yeah.
and their whole
Yeah.
Michigan rivalry with the dueling commercials now. And, I can't go 5 minutes without seeing a Loan Depot commercial. My guess is they'll be in the mix somewhere as well.
Absolutely.
But any thoughts about, you've worked for a few different really prominent kind of medium-sized independent mortgage banks. Somebody in your role running one of those companies, what are your thoughts when you see these big mortgage companies just getting bigger and bigger and bigger and going public and scaling? I mean, does that give you trepidation? Does it make you proud for the IMB fraternity? How do you view that?
I think any company that makes it to the point where they've become so successful that they go public, you have to put your hat off to them and say, great job. I mean, you obviously ran a company that was profitable, that investors want. And so you can't take that away from them. That's not my jam personally. I like the smaller to mid-sized company because I think when you go public and now you're beholden to this whole group of investors, and I think it has a big change on culture that I'm not sure is super positive, but I think that will bear itself out. But I'm super proud of them. I think it's great. I think 2020, if you're going to get it, if you're going to make that move in the mortgage business, 2020, 2021 is definitely the year to do it. You're going to look really great to investors. Just hope those investors understand the cyclical nature of the business long term. That's my biggest concern with that is are these people that are investing in the company going to have proper understanding of what the business is? But like I said, I think it's great. I think more power to them. I do think that in order to hit those profits, I think it is going to impact those of us private, the smaller IMBs. I do think there will be an impact to long term. We'll see what that looks like from a competitive standpoint. But all in all, I really believe in the IMB, and I believe in the power of the local regional IMBs who really understand their communities to be able to serve them, especially when you're purchase market driven and when you really can understand the market that you're in. I think that really helps set us up for success.
It's gonna be very interesting to see how it plays out. Not a lot of mortgage companies that don't service or do other things. Obviously, a lot of the big money center banks that are big mortgage lenders are public. Mr. Cooper, PennyMac, public companies, but there have not been to this point mortgage companies that don't service, that are to a large degree middlemen that have gone public, and how Wall Street's going to receive that. And
Yeah.
it's going to be interesting to see how it plays out. One of many interesting things to follow here in 2021. So
Yeah, and if I can give a quick plug really quick, the 2020 Texas Mortgage Bankers Association 2021, our annual convention, we're actually going to have a panel that specifically discusses the IMBs and the IPOs. So it's definitely a big topic on everybody's minds.
nice. Are you guys still doing it at JW in San Antonio?
No, so this year, well, still the plan is to do it in Fort Worth, and it's the first time in a long time we've done it in Fort Worth. We're really excited. Our president Jim Clapp is from there, so we're hopefully still going to do it. Yeah, we love him, and we're really excited about it.
And when is that?
May. Oh my gosh, you're on the spot. It's the beginning of May. I'll get you the dates, but it's the beginning of May this year. So we've got Dave Stevens that's going to come and talk to us. It's going to be great. We're doing obviously 2020 rehashes. Hey, how did this impact? How did you change your business as a result of COVID? So a lot of good topics. I'll get you the dates. I'm sorry, it just completely escaped me off the top of my head. I'm a co-chair. You'd think I'd know that.
No big deal. And Rob Krisman puts in the chat 30 seconds of airtime during the CBS broadcast of the Super Bowl, going for nearly 5.6 million for a 30-second ad spot. So
crazy.
yeah. And good time to remind everybody, any questions, comments, anything, please. I'll always laid back, low key and interactive, anything we're doing here with TMC. So any questions, comments, thoughts anybody has for Erin or myself, please feel free to pump them in the chat or the Q&A, and we will voice them aloud. So all right, let's get into the news headlines. And I see right away in the Q&A a question about the new CFPB. I think it's the number one thing on the majority of mortgage lenders' minds right now. I think the tea leaves are pretty clear here that we are going back to at least Richard Cordray levels of CFPB oversight, a big departure from what we've had the last 4 years. And before I get into any specific questions, just your initial thoughts on, this whole direction that we're going to be going in from a regulatory standpoint.
Yeah, I mean, it's definitely a bit of whipsaw for us, right? I mean, so like you said, we have the Cordray, Obama administration, and then going into Trump, and the Bureau kind of converted to being more of what I personally feel a regulator should be, which is more collaborative and working with us to try to make sure we're doing things in the right spirit and the right guise, but without being punitive, right? It's clear that is changing. I mean, one of Biden's first things that he did was got rid of Cappy. So, it's very clear when you go and do any amount of research on the nominee for the head of CFPB, it's everything. I think I read the word aggressive, 15 times in bios about him. That's how people describe him: aggressive. He goes after, punitive, litigious. We read all that. So we're going away from that, like, at least it appears to be that we're going away from that, hey, let's collaborate and make sure that we're working together as a regulator and as as an industry to that, like, oversight bureaucracy. We're going to get you and slap you on the wrist kind of thing. So, and obviously as an industry, we want to be doing things the right way, but we also want to make sure that our regulator is not out to get us and out to more help make sure we understand and follow the rules the way we should be.
Yeah, I was talking with Rob Krisman about this on the rundown this past Friday. Overall, God, our industry is so much more compliant than it ever has been by great multiples.
Yeah.
That said, I think the thing that frustrated all of us about the former iteration of the CFPB was just, mortgage industry has consistently said, we will play by the rules. We just got to know what the rules are. And it's always not that cut and dry, especially when it comes to RESPA, and marketing services agreements and that
Fair impact.
Yeah, I mean, it's a very fine line between, paying a real estate brokerage to, be able to market to and have desk space and offices and things like that, and not have it all be about referrals and all the things you need to do to make sure that you're compliant there. But I saw the interim director of CFPB, I forget the guy's name, but I read a column about, he kind of came out and laid out what the focus of the Bureau is going to be. And, the things that he immediately touched on were servicers, especially servicing things related to, borrowers in forbearance and making sure that they have all the rights afforded to them in the CARES Act. And then fair lending, which I've been talking about this. My prediction is this is going to be the biggest area of focus for this new CFPB. Our depository lenders at the Mortgage Collaborative already having to deal with fair lending audits, making sure they're not redlining and being beholden to lending in areas where they have borrowing footprint. And I think you're really going to see that be a focus of this new version of the CFPB. Just from your seat, as it relates to fair lending, your thoughts there and things that could be coming down the pike to independent mortgage bankers.
Yeah, I mean, and it's not just with the CFPB, right? I mean, with Marcia Fudge getting nominated yesterday for HUD secretary as well. I mean, it's clear that across the board, like you said, with this administration, it's going to be a big focus. And so it's something that us as lenders, we've got to be looking at it. We've got to make sure that we're using the data and analytics available to us, make sure that we're understanding the rules, that we're making decisions that are not going to get us into trouble. So, I think that is definitely going to be there. And what that really ultimately is going to lead to for us is we are going to have, more safeguards, more software, more people looking at things. And I think it's just going to lead to obviously increased costs overall, I think it's going to have a negative impact on rates as well, but it's definitely something that's going to be there for us, and really, really just all the things, honestly. Like, I'm just kind of looking at all the things that I know that they're going to go after and that they're going to start, trying to regulate us even more on. Servicing is really, honestly, something I feel is the biggest one. I think with everything that went through with COVID, with, like you said, all of the forbearances, I really think servicing is going to be a massive, massive focus for them. And I think it's not going to be just the fair lending piece, but I think servicing is going to get a really, really big, awakening with the new CFPB.
Absolutely. With Erin D, the COO of Loan People out of Austin, Texas, here with the Last Week in Mortgage Today. And Erin, you guys are based out of Austin, Texas, which is obviously just an emerging, cool city. I know you guys are doing a lot of your volume there. And one of the things I love about you is you are like a data and a tech nerd. And so like, somebody that does a lot of their lending in one big market, the demographics of Austin, right? And the direction that the CFPB could be going with independent mortgage bankers is like your application mix should look at least somewhat like the demographics of the communities that you represent. But you made a good point. I think data and technology is going to make that being in compliance with that a lot easier. I remember back in my banking days, like these archaic, I forget what they called them, but they were maps of, that showed different like income pockets. And the bank people are probably laughing at me right now because I'm forgetting about, but data and analytics is going to make it much easier to be compliant, right?
Yeah, absolutely. I mean, I don't understand how people who didn't have really good BI and really good software did it before. I mean, it's insane. I guess you just hired a lot more people, but yeah, it's absolutely massive. But the good thing is the tools that we have available to us now is you can look on real-time dashboards and see where your application's coming from, making sure you're in all the right MSAs, making sure that your rate spread is where it needs to be. So, and even just go through all of the HMDA software that's available to us now that has just really great tools to help us get ahead of that. There you can do, we're going to have to do fair lending self-assessments, but all the technology is there for us to make it easy on us. So we just have to make sure we're actually paying attention to it. And it's not one of those things that just goes to the wayside. Oh, we'll do it next quarter. We'll look at it next quarter. It's something that you've got to have somebody dedicated to and with their eyes on a real-time basis year round.
And some other news headlines this week. One was the average purchase loan amount, another record high, 395,200. Case-Shiller, which is the large home value index, indicated that home values went up 9.5% year over year in November. Those are obviously both big numbers. You're in Austin, Texas. That is an emerging market. Have you seen values just skyrocket in Austin as a mortgage lender in the city? How do you view that?
It's insane, honestly. We are seeing into Texas specifically a lot of an exodus from California of a lot of technology companies specifically. And so we not only have our normal market that's just on fire, but we are getting, people from other states, mostly California, coming to move here as well. And so what you're seeing is you're literally seeing home scenarios where the sellers are getting 70, 80 offers over a weekend. I mean, it's absolutely insane. If you finding a house in the Austin area for, less than $400,000, it's been on the market for more than a few days. There's something seriously wrong with that house, right? It's just absolutely on fire. We're seeing, purchase prices just going up, people coming in and offering 100,000+ over list just to try to get the house. And that's obviously having an impact on us from the investor side. I'm not, Fannie Mae just recently came out with their lender letter regarding, the importance of due diligence on reviews, and aggregators are talking a lot more about CU scores, and, they're not what they won't buy and what they require at certain CU scores. And when you're in a market like Austin and other areas that are seeing the appreciation we're having, we have those high risk scores, right? So then that affects, okay, well, how are we underwriting and how are we making sure that we have collateral that is secure, collateral that is marketable to our investors as well. So it's, it's not just seeing the prices go up, but it's also, okay, well, how are we as a lending industry able to manage that and keep sanity around it as well?
Good segue to a question that we got in the Q&A, and any questions, comments anybody has, please feel free to drop them in the chat or the Q&A. The question is, Erin, early last year, there was concern about COVID forbearances leading to a high amount of EPD and buybacks. Is there any chatter about an increase in lender buybacks?
Not that I've heard thus far. I'm going to knock on wood on that one. We haven't seen it. Now, granted, at least the lenders that I spoke to, we tried to move really fast and be really, really careful about it. And, 24-hour VOEs before closing, signing COVID attestations, just training our customers basically. So it hasn't borne out just yet, but that doesn't mean that it's not coming. And I really hope it doesn't. Like you said earlier, we've just really worked hard as an industry to be compliant and to play by the rules and to make sure that we weren't putting people in loans into situations that was bad for them, especially if their employment was in trouble. So I'm hoping not, but could.
All in all, I keep going back to this. Really, the mortgage industry today is so much smarter, so much sharper, so much more compliant as a whole. I think that was borne out really when the pandemic really hit hard in mid-March. I mean, I remember our members, it was like a week after all that went down, still in March, that we're jumping on Zoom calls together, talking about things like you just mentioned, like things that they were doing, sharing strategies on how to mitigate buyback risk. If it was VOEs and, very late in the process, just before closing, things even they were doing after closing to help mitigate risk. And I just think that all in all, it is, and I think that helped lead to, all in all, I mean, the buyback reality has been far less than the fear that we all had, right, in early March.
Yeah, absolutely. No, and again, I say that with not wanting to jinx myself. I'm not super, super superstitious, but, yeah, I mean, I just think that this industry as a whole has just learned so much from, the 2000s, the early 2000s. And I think those of us who were a part of that, we were extra cautious in making sure that we were really making the right decisions by people.
So the more general business climate. All right, now we're a month into 2021. It's been a good start to the year. Rates are still low. Volume's down a little bit, but still good. I think most of the economists projecting 20-25% total drop off in volume for the industry for this year. I mean, your growth aside, just how do you view 2021? Do you think it's going to be 25% less total volume than last year? Or do you think it'll be more close to the volume that we saw in 2020?
I actually think it's going to be closer. The reason I say that is because we still are in a fairly low, interest rate environment, and I do think rates are going to go up over the year. I don't think we're going to end where we started. But that being said, is I think there's still so much opportunity for refinancing to happen. But for those of us who are purchase market driven, I think that if you're focused on your purchase business, you're going to continue to have a really great year. And the reason for that is because, people are starting to go back to work, or people are moving and realizing, hey, I'm going to get a second home somewhere because I can work remotely. And I think remote work has really helped that a lot. I think that's going to fuel a lot of purchases as well. I can obviously speak to us. Looking at us, our application volume in January of 2021 versus 2020 was up. Application volume was up 8% and lock volume was up 12% over our top lock and application month last year. So even better than our summer by 8 and 12% respectively. So, I think that's just going to continue to prove itself out. And I think that the companies that continue to stay focused on purchase business are the ones that are really going to still have an equivalent year to 2020, perhaps a little down, but I think it's going to be pretty close.
Yeah, I think, purchase activity in general, I think hard to imagine a scenario where there's not more purchase activity in 2021 than there is 2020, just because of, kind of like the delay. And we didn't have a lot of that in the spring. We didn't have your typical spring buying season. Again, you look at economists across the industry, the most noted ones projecting anywhere from an 8 to 15 to 18% increase in purchase activity, all in all. But where I think, the optimism is coming from, like you just alluded to, is on the refinance side, that there is still a very large refinanceable, population of people out there. And then also, I think, just the lingering inventory issue that doesn't stand to fix itself anytime soon. I
Right.
think you have a lot of people are just like, it's screwed. I'm not bidding against 70 other people for a house. and I'm the renovator, maybe improve my own home. And I think you're going to see people take some cash out to do that. Renovation loans. What do you think about that thesis?
I have to agree with you. I'm a huge fan of renovation loans, especially in an area like Austin where there's very little dirt. So, you've got a lot of older homes that people are already doing it, but will just continue to come in and just renovate, remodel, and update their homes. I love reno loans, and I think it's going to continue to be a big deal.
What's the one street in Austin? It's got a bunch of cool bars on it, and it's just got like houses like off
Well,
the
I think that the answer that I would give is probably different than you're probably thinking Rainy Street, if it's the one
rainy.
with all of
Yeah,
the
yeah,
houses. Yeah,
exactly. Yeah.
yeah, yeah, yeah. I
Because
love
that
it.
looks like they just plopped that like in the middle of a residential community,
Yeah, they
like that
did. That's
string of
literally what it
bars,
was.
and that's a pretty cool area. So,
Yeah.
all right, mortgage technology. You're a very tech forward individual. I'm just curious, like starting a company in 2020, and like, I mean, just take me through the mindset of assessing technology options, partners, things you were looking for. I think every mortgage lender, the ones that are on here, the ones that'll watch or listen to this after the fact, everybody's assessing technology on some level. Really interested in your perspective on, that climate in general, and, how you approach that over the course of the last 15 months here.
Yeah, so my number one decision was my LOS. That was a very big one, and I did not go with the one that is most prominent in this industry for several reasons. And we were very happy with the one that we went to. But really, your LOS, because you want so many things to talk to each other, your LOS was the first decision you have to make. So when doing that, it's how easy is it for the loan officer to use and the basic functionality they have to do. But then once you know your LOS and you know all the different partners, then the fun starts, right? Because then you kind of know who you can and can't work with. And for me, it's ease of use, and it's being able to stay, on, reliable and consistent. Like if you're breaking constantly, or if there's constantly problems with your system. So, that's a huge one. And that's one that I think a lot of technology providers go out there and try to do a lot of cool things and integrate 500 things into things. And what I've found time and time again is, that just is more things to break. And so sometimes, simplicity, the elegance is in simplicity. And so you find a tool that does what you're trying to do and does it really, really well and can stay consistent. And then you can just continue to build on from there. And I would say, my number one vendor for that is Domo, my business analytics software, and I utilize the help of Richie May. They do their tech consulting services. They help with that. They're awesome. But my Domo, I actually connect in multiple different services into my BI provider, and it gives me real-time data that combines my financial data, my accounting, plus my LOS, plus my marketing tool, building and pricing things. And so really, like, it's having that one hub that's the ability to put everything together that tells you what you need as a leader in the organization, so that I can look at one screen and say, okay, this is where I'm seeing the trends go. This is what's happening. This is where I'm seeing things move. And it's looking at everything. Has been the key. That has actually been like the number one thing that I put in from a technology perspective.
That's excellent. Thanks for sharing that. And
Yeah.
I see our buddy Scott Colclough from Vice Capital Markets puts in the Q&A, Texas MBA 105th Annual Convention, May 2 to 4
There
at
you
the
go.
Omni Fort Worth in Fort Worth,
Thank
Texas.
you. I appreciate. Thanks for saving me on that.
All right, what about the technology that's not here yet, Erin? I think we all know that, TMC, we started an emerging technology fund that launched back in November. It's a vehicle for our members to, assess and potentially invest in not only startup technology companies that are focused in the mortgage space, but even established mortgage technology companies that are looking for later series of funding to do additional things. It's been a very eye-opening exercise for myself, our members, getting a chance to get kind of a peek under the hood of some of the things that are being worked on that aren't quite here, at least not totally functional or mainstream yet. Have you been able to spend any time, given the craziness of what this last 14 months has been for you, assessing that part of the market, like emerging tech and stuff that is coming our way?
Probably not as much as I'd like to, in addition to, all the other things. We have IRLA coming up. And unfortunately, what I've heard from a lot of my vendors is they're focused on IRLA. And so, a lot of things I've requested for improvements and things like that have been pushed aside because we're told, IRLA. So I've been pretty focused on that. So I'm hoping once we get that, underneath us and we're done, I can get back to looking out for that latest and greatest, because I think there is still a lot of really great things. And honestly, like, I just don't feel like, I'm a little disappointed in how the industry didn't move so fast with e-notes. I thought for sure e-notes would be way more prevalent in Ron, especially after, with COVID, but, I'm just now getting aggregators come to me saying, hey, we're thinking about dipping our toes in this. And, we're going to issue our first Ron e-note this month. So, that was obviously a big thing that I looked at in getting the company started, and something that was a very big initiative of mine in getting the company up and running. I would have thought, though, that COVID would have pushed the industry a little more than it did. I was a little sad to see that.
Got a minute or two left with Erin D. of Loan People here on the Last Week in Mortgage Today. If anybody has any questions or comments, this would be the time for them. And yeah, I thought for sure, like when the pandemic hit, it's like, oh, a lot of things sucked. But one of the things I was like, oh, good. All right, like finally 6 years of talking about e-notes. Like this is the catalyst we need. And it seemed like, states were fast tracking legislation, but it really did not happen at least as quickly as I thought it would.
Yeah, absolutely, it didn't. I mean, and we did have some help. I mean, I actually think this is one where the government did do some good jobs in trying to get it moved on, through the FHFA. But still, as an industry, it showed there were some things we were still pretty slow to move on. But again, it was busy, it was crazy, resources. All of a sudden, companies who weren't remote had to deal with converting, workforces to being remote, and that occupied IT departments. So, you give grace there, but I definitely would have thought that we would be a little bit further along by now.
Last question I have for you. We talked about, the assured direction the CFPB is going to be going back in. We talked about Marcia Fudge's appointment as HUD secretary. Anything else just with the change in administrations as somebody that's, kind of managing the day-to-day operations of a mortgage banking company that you have your eye on as it relates to a change in administration?
I do. So the FHFA is one that I'm also looking at. They just announced that they've got a new general counsel in there. And the thing that I've seen come out of FHFA a few times now is that they want to be a world-class regulator and offer us world-class regulatory, experience. And honestly, only a bureaucrat would think about a regulator being world-class. Like that just, I don't know why I read that and it just drops my jaw, because that means you're trying to come in and make a mark and do something. And I just, coming from a bureaucracy, I don't necessarily know that I trust that that's really best for the consumer and best for the industry. So that's also something I have my eyes on. I could just be being overly critical, but it concerns me when I see a regulator coming out saying they want to be world class.
Right. A regulator saying they want to be world class, and another regulatory body, using the word aggressive multiple times in their. Oh boy.
It's concerning.
The mortgage lending pendulum, it never can stay in the middle. It's here.
It's exciting.
Like never, like just stay here.
At least we're not in a boring business.
That is the one good thing. It never stops changing, and every time you think you know what direction it's going in, it takes a left turn somewhere. So.
Yep.
Erin, thank you so much. Love talking about the business with you. I really appreciate you joining me this week on the Last Week in Mortgage Today.
Thanks. Go Buccaneers.
Go Bucks. Good luck to your Buccaneers on Sunday. We'll all be watching, obviously. And to all of our attendees, thank you for taking some time out with us. Same time, same place every week, 2 p.m. Eastern, every Tuesday, the Last Week in Mortgage Today. Thanks, and have a great week, everyone. Take care.